Hi, this is Keith Schneider, CEO of MarketGauge.com with this week's March 10th edition of Market Outlook. So be sure to sign up for this free newsletter by going to MarketGauge.com if you like it and you find it helpful, or join us on our new YouTube channel. So without further ado, let's take a look at the charts. This week we had an interesting correction but quickly reclaimed a bullish market phase. Let's take a look at that right now. So first of all, you can see that the 50-day, which is this blue line, sharply pointing up and accelerating to the upside. The 200-day moving average is this solid green line here, also now starting to turn positive on the slope. Now, what was interesting this week is that you had a huge gap down, and you also had an island bottom of some sort, or an island, because you left a gap to the downside in here, and as you can see, you gap to the downside, and with Thursday's action, the gap up, you've also left these 2 days here that can be considered an island bottom. But more importantly, of course, many people were proclaiming the top to the market with this big gap down in several days under the 10-day moving average, which is the first time it occurred since mid-December. So that was important, but the market has quickly reclaimed it. So you can see that we're no longer overbought nor oversold. We only had one major event in terms of volume. That was pretty much to the downside on that 200-point day. But meanwhile, we've pretty much reclaimed a completely bullish scenario. Furthermore, let's take a look at the weekly chart. On the weekly chart, you can see we're well above the 65-week moving average as well as the 200-week, and we're starting to obviously clear these critical highs that were set in 2011. So, a thing to note here, though, is on the relative strength index, we are in overbought readings on the weekly chart. So that by itself is an interesting warning, but it's not a sell signal, right? We want to see confirmation in a couple of other time periods or other short-term market structure. It's just not there. Now, let's take a look at the Qs. Qs, a little bit different story. We only had really, if you go to the daily chart, you can see that we only had 1 day close under the 10-day moving average. And again, similar scenario, since mid-December, we've never closed under the 10-day moving average. That was the first close. You had 2 days there. Not quite the same island bottom or the reversal pattern that you saw in the spiders. We sort of filled that gap that you can see in here. Let me enlarge this. So you can see that the gap isn't nearly as wide. Just about, well, you do sort of have an island here now that I'm looking at it. So you've got this this interesting type of reversal pattern, an island reversal, where we drop down here, and now with the gap open on Thursday and Friday, we left this gap this day down here. So that's a pretty positive pattern. Also to note, we had on Friday the highest close we've had in NASDAQ in quite a while. Let's see, I think that is since, well, we actually had that long-term up channel. So this is in the NASDAQ 100. If we go back to the monthly charts, you can see that this is the highest close that we've had since 2001, or actually the year of 2000. So that's fairly significant. No question, the long-term monthly chart, 80-month chart intact. We're not quite overbought on the monthly chart, so there's more room there. However, we do have a bit of caution here on the weeklies. We also, like in the S&P, getting a little bit rich. These things can stay rich, so we're looking for confirmation in other time frames. Okay, let's take a look at interest rates. Long-term rates, bonds, 20-year TLTs, been hanging on to that critical support level. You can see we tested it on Friday and again bounced off that critical support level. Let's put in a trend line here, or at least a horizontal line. As you can see, critical support on a closing basis. Let me format this line a little bit heavier, and you can see this is very, very critical support. Any close beneath this 115 level that we've been talking about potentially confirms a long-term top that we've been mentioning, right? You can see we had this huge spike here with the sovereign debt issues and with the downgrade of the United States debt in September-October timeframe. Since then, rates have sort of paused, gone sideways, along with the Fed's easing and QE2 and the easing policy that they've tried to implement. But nonetheless, overall, if we can get below this 115 level on a closing basis, very, very important level to watch. Be interesting to see, on the other hand, if we can take out this trend line and move again through these critical point right here at around the 118 level, 119 level, and this trend line, we can have yet a test of the highs. But right now, it seems that there's pressure and rates are rising, so a bit. And if we can get through these levels, going back again to the longer term chart, let's take a look at the weekly chart. You can see we're sitting against the old highs of what occurred in 2008 and 2009, and we've done a lot of work in here. So still, we've been talking about a potential double top or a potential pause here, consolidation for yet another move higher, which in this case would indicate super amount of stress on the global economy. All right, let's take a look at some market timing and sentiment indicators. Over here, we have the VIX. With the VIX, you can see that sentiment with that 1 day or 2 day spike down in the markets, the volatility index moved up, but nonetheless, once the market retreated, we're now back down pretty much to the lows. One of the things that we like to look for to see if there's some irrational exuberance, too much bullish sentiment, would be a move down and a close beneath the lower Bollinger Band. We're not there yet. So if anything, you can say sentiment is sort of back to the lower end of what it's been trading at recently, but overall, not excessively bullish, just in positive territory overall, as we're beneath the 200-day moving average and as well as the 50-day. So sentiment remains as a bullish indicator. Now, interesting, we had a couple of things that happened very, very quickly. So you got to stay on top of this. Let's take a look. Wrong indicator here. Okay, so we have this is the 5-day up-down volume indicator. In this particular case, you can see we touched our oversold region on the sell-off and moved back nicely. So you can say that we're on a bounce off of an oversold reading that we hadn't had really since the big sell-off in late December. So a little bit got a little bit ahead of ourselves on that downside, and this indicator kicked in. Also to note, the McClellan Oscillator. Let's take a look. This this center chart right here is the McClellan Oscillator, and you can see the McClellan Oscillator actually worked off its overbought reading up in here and got to actually oversold on the 200-point down move and has since recovered. So you can say we're now in an upward, we're working off of an oversold reading. So this is midpoint, plenty more room to move to the upside. If the trend continues, we have a bullish bounce off of an old oversold reading on the McClellan Oscillator, which is more intermediate term in nature. Furthermore, we have some interesting things in the currencies. Let's take a look at the euro. You can see the euro is over here. This is FXE, so it's the ETF representing the euro. You can see we broke down across this valid trend line, so we are also holding this 50-day moving average. But overall, you can see the euro is heavy, and furthermore, the dollar, represented by UUP, which is a blend of many currencies, looks like it's coming out of this basing action here. If we can get above 22.40, we can certainly see a nice rise, and it could be the mark of a new era for the dollar. We have a move here over the 50-day moving average. Would like to see it confirm a couple of days and resume its uptrend and test these highs. But interesting to note, we're above the adaptive moving average, above the 50-day moving average, although it is sloping down. So what we have here is the beginning of what I would consider a weak bullish phase. Like to see it confirm and have that 50-day start turning up. But the dollar is definitely getting stronger and has been stabilizing in the world markets. So, with all the confusion, with the Greek debt crisis supposedly resolved, but yet there's a default, not exactly straightforward or clear what the outcome is going to be on that. So again, you have to stay fluid, let the charts tell you what to do, and definitely follow the short-term structure of the markets. So that's it for today. Look forward to seeing you next week, and bye for now. And again, this is Keith Schneider, CEO, MarketGauge.com. Don't forget, if you like this newsletter, please sign up at our website, MarketGauge.com, or you can follow us on YouTube. Thanks, and bye again.